Imagine checking your bank account and realizing most of that money was never actually printed. No trucks, no minting press, no physical cash moving anywhere. It just appeared, and not by accident. This isn't a glitch in the system. This is the system. Because today, the majority of money in the world isn't created by governments. It's created by banks. Quietly, legally, and in a way that almost no one fully thinks about. Let's start with something simple. You walk into a bank and take a loan of 1 lakh rupees. The bank doesn't go into a vault and hand you someone else's money. Instead, it types numbers into your account. Your balance goes from 0 to 1 lakh. That money didn't move. It was created at that exact moment out of nothing. Now here's where it gets strange. From your perspective, that money is completely real. You can spend it, transfer it, invest it, lose it. But from the bank's perspective, that same 1 lakh rupees is also recorded as an asset because you owe it back. So in one move, the bank created an asset for itself and money for you. No printing press required. This is called credit creation, and it's the foundation of modern banking. But most people imagine banks as intermediaries, like safe boxes that store deposits and lend them out. That's not how it works anymore. Banks don't just move money, they expand it. Let's zoom out. If you deposit 10,000 rupees into a bank, it doesn't just sit there. The bank keeps a small portion as reserves and lends out the rest. That loan becomes someone else's deposit, which gets lent again and again and again. This is called fractional reserve banking, and it means one deposit can multiply into several times more money in the system. 10,000 rupees can quietly become 50,000 rupees, 1 lakh or more in total circulating money, not because new cash was printed, but because new credit was created. Now here's the uncomfortable part. This entire system runs on one assumption, that not everyone will ask for their money back at the same time. Because if they do, the system breaks. That's what a bank run is. Not panic, just math catching up. But in normal times, this system feels smooth, efficient, even helpful, because credit fuels growth. Businesses expand, people buy homes, economies move forward. And as long as loans are being repaid, everything looks stable. But there's a hidden consequence. Every new rupee created this way comes with debt attached. Money enters the system as a liability, which means for the system to function, debt must keep growing. Think about that. If all loans were suddenly paid off tomorrow, a huge portion of the money supply would disappear because that money only exists because of those loans. So the system depends on continuous borrowing, not as a side effect, as a requirement. Now layer interest on top. When a bank creates 1 lakh rupees, it expects 1 lakh plus interest back, but it only created the principal, not the interest. So where does the extra money come from? From more borrowing. New loans create new money, which is used to pay old loans, which creates the need for more loans. It's a loop, a stable one most of the time, but a loop nonetheless. This is why economies are so sensitive to interest rates. When rates are low, borrowing increases, money supply expands, growth accelerates. When rates rise, borrowing slows, money creation slows, and suddenly everything feels tighter. Because it is, not just psychologically, mathematically. Now, let's address a common belief. Money is printed. Technically true, but incomplete. Physical cash is only a small fraction of total money. Most money exists digitally, inside bank balance sheets, and that money is largely created by private banks when they issue loans. So while central banks control the rules, commercial banks control much of the creation. This creates a subtle but powerful shift. Money isn't just a neutral tool, It's a byproduct of lending decisions, which means where money flows depends on what banks consider profitable, not necessarily what society needs most. For example, banks are more likely to fund real estate than small, risky businesses. Why? Because property is collateral, predictable, safer. So more money flows into housing, prices rise, assets inflate. Meanwhile, other sectors starve for capital, not because they're useless, but because they're uncertain. Over time, this shapes the entire economy. Asset prices climb faster than wages, debt becomes more common, and wealth concentrates in places where credit flows easily. Again, not by accident, but by design. And here's where it gets even more interesting. Banks don't create unlimited money. They're constrained by regulations, by capital requirements, by risk, but also by confidence. If banks feel uncertain, they lend less, which means they create less, which slows the economy, which increases uncertainty, which leads to even less lending. You can see how quickly this can spiral. This is exactly what happens during financial crises. Credit contracts, money supply shrinks. Even though no one physically removed money, it just stops being created, and existing loans start getting repaid or defaulted, so money disappears, silently. To counter this, central banks step in. They lower interest rates, inject liquidity, sometimes even create money directly through mechanisms like quantitative easing, trying to restart the cycle, encourage banks to lend again, encourage money to be created again. But notice the pattern. We don't just need money, we need newly created money constantly to keep the system running smoothly. So when people say money isn't real, they're not entirely wrong, but it's not imaginary either. It's conditional. It exists because of promises, because of obligations, because of a shared belief that loans will be repaid. And that leads to a strange conclusion. The money in your account is someone else's debt, and the stability of that money depends on the stability of that debt. Which raises a question most people never stop to ask. If money is created through lending, and lending depends on confidence, and confidence can change overnight, then what exactly is our financial system built on? Not gold, not cash, but trust. Structured, leveraged, and constantly in motion. And if that trust ever breaks, what happens to the money that was never really printed in the first place?